Good afternoon. My name is John Courtney, financial planner with Village Wealth Advisors. I prepared this presentation for our clients and business partners so you can better understand how the coronavirus is impacting our economy and your portfolios, and what we might look for as this crisis continues to develop. What I've prepared here is a look at what year to date the S&P 500 has done compared to coronavirus cases here in the US. I've also framed this crisis in terms of essentially achieving 4 different possible levels of crisis as the disaster continues to unfold. Now, year to date, the S&P 500 is dropped about 35%. As that has happened, you can see that the coronavirus cases have continued to grow. And as of about March 22nd, there were about 300,000 cases worldwide, but that is increasing rapidly. Now, I believe that this crisis really began as an economic crisis on around January 22nd, when we saw the Wuhan province in China suspend all air and rail transport. Now, that was the first level of this as an economic crisis, really disrupting the supply chain that businesses around the world rely on. But the next level of this crisis was reached on February 25th, when Italy signaled that it would lock down towns and villages in the northern part of the country. And the S&P 500 immediately reacted with a big drop because of that. Their decision to lock down those villages really signaled a global reduction in worker productivity and brought this crisis to the level 2 economically. Now, level 3 of this economic crisis was achieved when we started hearing here in the US that major events were being canceled, such as the canceling of Coachella and Stagecoach on and around March 10th, followed by the canceling of the NBA season, the NHL season, the postponement of the Major League Baseball season, and then that was quickly followed by major companies telling their workers to stay home and work from home. That level 3 really marked the beginning of us seeing a reduction in possible consumer spending and business investment, 2 hallmarks of any recession that the US would go through. Now, currently, I believe we're in the level 3 economic crisis, but this won't become unrecoverable in the short run until we hit a level 4 crisis, which I would describe as a global and US debt crisis. Now, that could potentially happen if we see several different events happening either globally or here in the US. Globally, we would look for a level 4 trigger if we see Italy or Spain or one of the very hard-hit European countries begin to default on their government debt. Also, we could possibly look for China to do a serious devaluation of their currency. Now, here in the US, we're going to look for possible triggers such as banks or financial institutions not meeting their capital requirements. Also, we might look for investment-grade businesses rated A, AA, or AAA filing bankruptcy or defaulting on their debt. The other possible trigger could be a dramatically high unemployment rate, something in excess of 20%. If that is not matched by serious government stimulus, either providing unemployment benefits, then that could absolutely trigger a level 4 economic crisis for the markets. Historically, I want to compare the crisis we've had here against the last financial crisis in 2008 and 9. Now, so far, we've suffered about a 35% drop in the market. Now, here you see a chart of the Dow Jones Industrial Average, okay? And the drop that we've had is right here, all right? So currently, the Dow stands right at about 19,000. The levels that we are at now are roughly the same as the level in the Dow when Trump became president over 3 years ago, okay? So we've essentially erased all the gains achieved from the major corporate tax relief bill that was passed by the Congress and signed by the president, which really juiced corporate profitabilities and sent the market up. We've lost all of those gains from the past 3 years. But we still have all of the gains achieved in the market over the prior 8 years before that, okay, which were huge, right? We had huge gains over the last 8 years in the market that are still baked into the prices that we're at today. Now, the reason that this crisis has felt so shocking from a stock market point of view is we've never lost this much stock market value, a 33% drop. We've never lost that much value this quickly. Even during the Great Depression, we did not see market losses happen this fast. Matter of fact, in 2008, it took almost 12 months for the market to lose about a third of its value. And then after that, it took another 4 months for it to lose another 25% of its value. So during the Great Recession, overall, the market suffered about a 50% loss in value. If we were to have losses in the Dow similar today, similar to what we had in the 2008 crisis, we would see the Dow drop roughly another 5,000 points down to about Dow 14,000. Now, I believe that if we hit a level 4 crisis where we start seeing, a global or a US debt crisis, and we see some of those triggers happen, I feel like that is absolutely achievable, and we need to be prepared for that. So speaking of being prepared for, we do financial plans for all of our clients, and we do retirement projections for all of our clients. And part of that is a stress testing of the cash flow plan that we put in place. One of those stress tests is we call the bad timing test, where we simulate a 2-year loss of about 30% in the value of a client's portfolio, a loss of 20% the first year and a loss of 10% the second year. And we try to simulate, can the client keep up their promised withdrawal rate and still make it to the end of their life without running out of money after suffering that huge loss over a 2-year period? And only if the answer is yes, do we tell the client that their plan is sustainable and that the withdrawal that we've told them they can depend on is sustainable. They have to pass this bad timing test. Now, a 30% drop in the portfolio, right now for most of our clients, after suffering about a 35% drop in the stock market, most of our client portfolios are down right around 20% right now. Okay, so we've essentially hit that first year drop of 20%. Now, we don't know what's to come, but as of today, my clients can still rely on the financial projections that we've done. The drop that we've suffered is within the tolerances of the stress tests that we've run. If we see another 10% drop in portfolio value, which would be represented by maybe another 20 to 25% drop in the stock market, we would need to revisit some of those retirement projections, some of the assumptions we've made, and some of the conclusions we came to, okay? Because we can no longer be confident that the projections are within the stress tests that we've run, but we're not there yet. So what is our portfolio management strategy going forward? Well, I really want you to think of it in 2 different parts. One is a cash flow strategy. The other is a rebalanced portfolio strategy. Now, for my clients, their cash flow, any cash flow you need is going to come from 3 different sources. It's going to come from dividends paid by stocks. It's going to come from interest paid by bonds. And it's going to come from principal or capital gains cashed in from the investments. Now, most of that over the next coming years is probably going to come from your cash, treasury, and bond mix. We can't really count on stocks to be a source of cash flow for the coming years. But because of the preparation that we've done in our clients' portfolios, we feel very confident that our clients who need cash flow for the next 6 months have enough cash on hand to satisfy all their cash flow requirements. Now, beyond that 6-month period, we have enough treasuries in your portfolio to satisfy your cash flow needs for a further 2 years beyond that. Then after cash and treasuries, we have diversified bonds to cover cash flow for a further 3 years beyond that. So I feel very confident that for my clients who need and expect cash flow from their portfolio, we don't need to rely on stocks at all for the next 5 to 6 years. This is what's going to allow you to ride out whatever volatility is likely to come. And we don't need to worry about stocks in the portfolio for at least 5 to 6 years. And avoiding selling low is the key to riding out any type of market volatility. So what is our rebalancing strategy then going forward? How are we going to manage the portfolio? Well, to talk about that, I need to go back and review a little bit of history. 2 years ago, back in February of 2018, all right, I became worried about a coming recession because 2 events happened. One was the yield curve either inverted or almost inverted, and Trump began a trade war with China. That made me worry that if we went into a recession, it would be longer or deeper than normal. And so I needed to position the portfolio more defensively because of that. So what we did was I went through and I sold about 1/3 of my clients' US equities, representing about 10% of the portfolio. Okay. And I moved the cash from the US equities into treasuries and structured notes. Then about a year ago, I built on that strategy by bringing the allocation from 10% to 15%, creating a war chest to prepare for whatever coming recession might be. So with that war chest in mind, now we're in the middle of this crisis. But because we built up this 15% war chest, we can begin taking advantage of these lower stock prices and rebalance into the portfolio. So just last week, we did our first major rebalance, taking 4% chunk of that 15% war chest, and we rebalanced it back into US and international equities, buying now that the market has dropped about 35%. Our plan over the next 11 months is to continue rebalancing every month, adding 1% of that war chest back into the US and international equity market, allowing us to continue to buy low. Now, we can accelerate that strategy if we see the opportunity, or we can decelerate that strategy if our economic situation changes. But the idea is we've prepared for this recession. We've built up a war chest to prepare for this recession. Now let's capitalize on the opportunity that the market's given us. Now, no part of this rebalance strategy will jeopardize the cash flow strategy that I just spoke about. My clients will still have 5 to 6 years worth of cash flow available to them even after implementing this war chest rebalancing strategy. I hope you found this presentation informative and useful. I hope it adds to your sense of calm and confidence that your portfolio is well managed, that your finances are in good shape, and that we've prepared for an event just like this. If you have questions, I'm here. My team is here. We are prepared to respond to your questions and to speak with any of your friends or family or colleagues who are feeling worried. This is a wonderful opportunity for us to get in control of your finances, take advantage of any economic opportunities that might be there, and make sure that you have a plan in place, because there's nothing that adds to a sense of calm like knowing we have a plan, we've prepared, and we know what the decisions are going forward. Again, my name is John Courtney, financial planner with Village Wealth Advisors here in Westlake Village, California. Please visit us at www.villagewealthadvisors.com. I'm available if you have any questions. Thank you.